Hello everyone, my name is Ankushi Garg and in today's video we shall be discussing about the investment strategy, the Falcon Method. Let us know what Falcon Method is all about. The Falcon Method is an all-round investment process that relies on the principles of value investing, common sense and quantitative discipline. The goal is to construct a buy and hold portfolio with a focus on both income and the total returns. There are a few steps of the Falcon method. So let's begin. The first step, the quality criteria. As per the common sense idea, only invest in the top quality companies that have stood the test of time. These businesses have great internal economic fundamentals and long-term track records for performance and excellence. As a long-term investor aiming for wealth building and reliable passive income, one should go for the wonderful companies instead of the mediocre ones. The rule says stocks must have at least a 20-year immaculate dividend history, which means no dividend suspension or cut to quality. If a company has been able to pay growing dividends for decades, it's a sure sign of its consistent earning power. Taking this argument one step further, it is no surprise that companies with these characteristics tend to outperform. The second step is the value criteria. The common sense idea says everyone loves to bargain purchases. Buying top quality stock at low prices not only feels good but also leads to superior investment returns. Bargains are temporary as prices rise in the long run, boosting the returns to reflect the underlying quality of the businesses. As per the rule, take a multidimensional look at valuation, use indicators like price to adjusted operating earnings, price to operating cash flow, price to free cash flow, price to EBITDA, and examine their historical averages in multiple time. Compare the current valuation ratios to the historical averages and make sure that the current level reflects a fair or better price. If you go buy top quality stocks at below average valuation, the powerful force of mean reversion is on the side. The third criteria is the threshold criteria. As per the common sense idea, for every dollar that one invests, one wants to get the most possible money in return. Under a certain threshold, one is not keen to know the investment of your capital at all. Compare the prices that one pays for stock to the amount of free cash flow the company produces per share, FCF yield, the money it returns to its shareholders through dividends, and the dividend it pays. Taking the prevailing market conditions into account, set absolute minimum requirements for these three and only consider a stock worthy for the money if it meets all these criteria. The fourth step says yield plus growth. As per the common sense idea, all things being equal, the higher dividend and the higher dividend growth one gets for the money, it is the better. Total return is determined by three components: the starting dividend yield, the growth of the underlying company, and the changes in the valuation multiple. The stocks that survived the previous steps based on yield plus growth characteristics. Instead of using an oversimplified indicator like the popular Chowder number, employ a weighted multi-factor quantitative ranking with yield plus growth numbers of different time frames. The higher the yield plus growth rank, it is the better. The last step says sleep well at night. So, the common sense idea behind this is no matter how good a stock looks in a ranking system, if you do not feel comfortable investing in it, you will have a hard time holding when the panic erupts. Only buy stocks then one intends to hold for the long run. No matter how much one prefers quantitative methods, some things simply cannot be quantified, filtered, and ranked in an automated way. And the panic erupts. Only buy stocks that one intends to hold for the long run.